I'm Charlotte McLeod with investingnews.com, and here today with me is Marco Byrne, Managing Director at Terra Coins. Thank you so much for being here. Great to have you.
Great to be on with you, Charlotte. Thanks for having me on.
Really good to be speaking with you. I think we're going to have a great conversation today. I thought just because it is our first time talking, if you could begin with just a brief overview of yourself and your current work right now.
Yeah, so basically, my background was not in finance, it was in history. I studied history for my degree, but I was very much focused on economic history and the rise of empires and the fall of empires and the cycles that we see throughout history, and that's what sort of got me into gold and a realization that gold was money in effect throughout history. So, and from that, basically in 2003, I set up a company called Goldcore, which became the largest gold broker in Ireland. We had €1 billion in turnover between 2004 and 2019. And we were quite successful in Ireland and the UK in particular, but we had quite a lot of clients in the US as well, and Canada. And we specialize in bullion, coins and bars, and also in storage in some of the safest vaults in the world. And then I retired from that in 2019. But the gold bug got me again. And basically, yeah, Terra Coins came about because I had many people coming to me over the years, both Irish people and Irish American people saying, why aren't there Irish gold coins and Irish silver coins? Like, why are we buying, Royal Canadian Maple Leaf coins or the US Eagles or the Royal Mint coins? So, yeah, it got me thinking about it. And eventually I decided I had to do it. So that's how Terra Coins came about. So we created these beautiful Irish gold bullion rounds and medals, the Trees of Life. And now we're working on the legal tender gold coins as well, which we should be releasing fairly soon.
Well, great to go into your background. I always think it's interesting to see how people come to this sector. So we've got a lot to go over today. There's so much happening with gold, but I thought we could start with a broad question just to set the stage. So when you're looking at gold right now, where do you see it in the cycle? Where would you place us?
Well, it's very hard to know and to say definitively because there's so much going on. And as you suggested too, and you're alluding to, everything is a cycle, and they're big cycles, economic cycles, and I suppose monetary cycles as well. And I think in the economic cycle, it looks like we are on the verge of a quite serious recession because the whole economic growth for many years now has been based on debt and the increasing amounts of debt in the world, which has led to the increase in demand for goods and services. But we're not getting the same return on the increase in the money supply, and it's the same increase on the debt as we used to get before. And it seems to be a lot of indicators suggest we're turning over. And I think it's only yesterday the World Bank warned that I think economic growth in the next decade is going to be the worst since the 1960s. And unfortunately, I think they're probably right, because of the scale of the debt and the bond market, the US bond market, but indeed the global bond market looks quite vulnerable given the scale of the debt of many of the governments around the world. So, yeah, so I think we're towards the end of a sort of a economic growth cycle. I think we're going to go into a contraction cycle and have a recession, potentially quite a serious recession. I don't like the word depression because it's very depressing, but it could be quite a serious recession, because we didn't, in the last financial crisis from 2008 to 2012, we didn't really deal with the root cause of the problem, which was too much debt in the system. It was a global debt crisis ultimately. And we did kick the can down the road with the quantitative easing, and basically buying the bonds with newly created fiat currency to suppress the bond market. So they're going to have to try and do that again. So long story, I think we're at the end of that cycle, but a bigger cycle thing is actually the fiat currency cycle. And it's interesting to look at it in those terms as well. And the Federal Reserve was set up in 1913. And the dollar, obviously, we had a gold standard throughout the 19th century and the early 20th century. And 1 ounce of gold was $19.67. So just below $20 per piece in 1913. And then it was $33 per ounce, $35 per ounce in 1933 when Roosevelt devalued the dollar after the Great Depression. And then it was fixed until 1971. And then we had the stagflation and the Nixon going off the gold standard in 1971, and we saw the massive movement in the gold price in the 1970s. But when you look at those figures and how the dollar has been slowly devalued in the early decades of the 20th century, but that has accelerated obviously in recent decades and particularly in recent years. So it's interesting. So I think it's important when I look at it, I don't look at it as an investment anymore. We used to look at it as an investment in a portfolio and position vis-a-vis stocks and bonds. And there's nothing wrong with that per se, but I think it's better to look at it as a form of money, a form of saving rather than investment, because obviously there's no yield. Um, so it's a good way to look at it. It's not that gold prices are going up per se, it's that the currencies are losing value, the dollar is losing value, obviously. And the way to look at it is that 1 ounce of gold, it was basically, yet $20 was 1 ounce of gold. So you could buy 1/20th of an ounce of gold with $1. And today, gold is at what, $3,300. So you can buy 3,300 of an ounce of gold with that $1. So that's, roughly, I think it's over 99% devaluation dollar over time. And unfortunately, that appears to be accelerating as we see the gold price go parabolic. So, in terms of the price cycle of gold, we're not, well, I think we're middle to end, but it could go another 5-10 years higher, or it could be a short, sharp burst over the next year, 2, 3, 4 years. It's very hard to know, and there's so many variables, and it depends how powerful the central banks are. They proved themselves to be very, very powerful in 2008, 2012. With the quantitative easing and the actions they took by reducing the interest rates globally. Whether they have the same power again, it's led to be seen, because obviously there was huge global coordination then between the different central banks, including the PBOC, the Chinese central bank, the Russian central bank, and all central banks were very much aligned in the G8. But today, obviously, unfortunately, there's a lot more division in the world, and there is the de-dollarization phenomenon, which is ongoing as well. So yeah, there's so many variables. So it's very hard to be definitive. But I think the bottom line is, I've long thought that gold would go to $10,000 per ounce. People used to laugh when I never said it was a prediction. I just said I believe that's where it will go to in the long term. And very much in the next. When I set up Gold Course 2003, so I thought in the next 20 to 25 years, gold at $10,000 per ounce. And I'm very confident that we'll hit that level in the next few years. And there are obviously, JP Morgan has made a report saying that gold could hit $6,500 per ounce by the end of President Trump's term. So his term in office. So I think that's quite, some people see that as sort of a radical outlier, very high prediction. I think that's actually relatively conservative. I do think that genuinely 10,000. And a man that I followed for many years is James Rickards, and read all his books and met him, and he's a very interesting man. And his analysis is based on M1. He believes gold will go to $27,000 per ounce. And even as I say it, it sounds incredulous, and it sounds like I'm trying to sell gold to people, But I actually think it's quite rigorous, his analysis based on that M1, and the increase in the money supply in the US has been astronomical, in the trillions. 1 with 12 zeros is a trillion. It's a big, big number. People forget how big a trillion is. The debt is going through the roof, and wars are very, very expensive. So I think between 10,000 and 27,000 in the next, 4 to 10 years is quite a realistic scenario.
These very high gold prices, I think you're right. Maybe a few years ago, people would look at them and feel they're outlandish. But as we move forward, it seems like they're getting more and more possible. So thank you for going into all of that. And I
Mm.
think as we're talking about cycles, and maybe with your historical background, a good question for you might be, I know that when people are looking at what's going on, they're wondering if they can look back and see, okay, are the times we're in right now similar to a previous time, a decade maybe in the past, or are we living in unprecedented times that don't really compare to anything we've seen before? So wondering what your thoughts are on that idea.
Yeah, well, there are parallels even with the Roman Empire and the debasement of the currency that happened then, particularly in the 20th century, with the World War One and World War Two, and then Nixon going off the gold standard. But I think now in this moment in time, it is unparalleled, because I suppose back then to debase the currency, whether it be in the Roman Empire, they had to chip little pieces off the coins, you know. And then they began to debase by putting the base metals into the gold and silver and diluting the precious metal content in every single piece or every single coin, you know. So it was hard to do that, you know. It required a lot of effort on behalf of the emperor, the king, and his mints, and the people who the exchequers who managed the treasuries who managed the money, you know, and had to gradually dilute it over time. Whereas today with technology, it's quantum, you know, and you can go on a keyboard now and create trillions, you know. So, and I think that's a big driver of this de-dollarization phenomenon that we're seeing. Um, so yeah, it is unparalleled. I mean, the 1970s is the one that a lot of us have looked to, obviously, when you're looking in terms of price, and the stagflation we saw that period. And I think there are parallels with the 1970s because I do think we're going to see contracting growth and very high inflation. But at the same time, um, I've expected that economic contraction and high inflation for the last 10 years, and it hasn't happened. Although, sorry, there has been a lot of inflation, and I think inflation is underestimated, but economic growth has continued. But I think most of us realize that it's not really sustainable economic growth, you know. So, so yeah, but if you look at the 1970s price wise, obviously it was $35 in 1971, and it went up, I think, 24 times, $850. So, I mean, if you look at the recent lows in gold, um, well, so you can look at the different lows. You can look at the beginning of the bull market in 1999, 2000 bulls at $250 per ounce. Um, and when you look at it in those terms, up at 3,300, even then it looks quite heady and quite a big price move up. But given the scale of currency creation and the increase in money supply, but also relative to stocks and bonds, and you look at the price move in S&P 500 over the same time period, you know, and even when you compare it to property prices, and they've gone up multiples, you know, 5, 10, 20 times over the last 3 or 4 decades. So gold's price is actually, in some ways, it's just catching up to the price appreciation we've seen in other assets. So that's why I do think it is very, very sustainable. Yeah.
So we're talking about all of these elements that if we put them together, it's a positive picture for gold, although of course in the world maybe it's a little bit difficult times right now. What are you seeing in terms of gold buying trends? I'm wondering who you're seeing buying and maybe what types of gold they are buying. What are you looking at there?
Yeah, well, obviously, it's like the elephant in the room is the central banks, and their demand is very, very strong, and it's forecast to be 1,100 metric tons plus in this year, 2025, and we've had 1,000 metric tons plus in recent years. And it's interesting, like I used to do a market update every single day from 2004 to 2019. Nearly every single day, Monday to Friday, when the markets are open, I would do a market update, you know, basically reporting why gold prices and silver prices have gone up, gone down, what were the factors driving it. And central banks were not really, it wasn't really on the radar. And in as recently as 2010, at the height of the financial crisis, central banks, and that was a big global financial crisis. You know, people forget Lehman Brothers going down. Then we had a sovereign debt crisis, particularly in the EU. There was a real risk of contagion. And in 2010, central banks only, with all that risk, they only bought 100. I think it was just under 100 metric tons in 2010. You know, so we're now at 1,100 metric tons. That's a 1,000% increase from the central banks alone. And this is the official sector. These are the people who actually manage our currencies, manage our economies. You know. So that is one of the big drivers, you know. And the World Gold Council reported, I think it was only last week or in the last week or 2 weeks, that there's a huge amount of gold being bought by central banks that's not even being reported, you know. So yeah, it could be 1,500, it could be 2,000 metric tons. And I think the Chinese only last month in May bought something like 60,000 troy ounces in 1 month. And that's a lot. When I used to report, when the Chinese are buying, the PBOCs are buying gold, they used to buy small amounts gradually, roughly, I think 10,000, 15,000, 20,000 troy ounces on a monthly basis. And they would report that to the IMF. But many of us reported back then when they started buying that this was a long-term trend, and that demand was likely to increase given the scale of the foreign exchange, dollar foreign exchange reserves that they have, you know. So it makes sense that they would diversify. And it appears that their demand is increasing, and that's just the reported demand from the PBOC. The Chinese also have SAFE, and they have another sovereign wealth fund. I can't remember the name of it, And, the thinking is that they're buying more gold, particularly from Africa, and that is not coming through sort of the Western bullion markets, that infrastructure. So that's huge, and it's sustainable, and I think it's going to continue for the foreseeable future. Um, yeah, the retail investor. Oh, sorry, yeah, high net worth are buying as well, and there's family offices are beginning to look at gold, obviously given the scale of risk in the world. So there's some big money that is beginning to diversify into gold. Um, but the retail investor, they're buying, but they're not buying huge amounts. There's no, sometimes you see these headlines, gold rush, and mom and pop investors are piling into gold, and they're flocking to gold and all that terminology. And that isn't really being seen. It seems to be a lot of repeat demand from people who've already bought gold, and they understand it and they trust it, and they're sort of adding to allocations. They seem to be going almost, overweight gold, if you're going to look at it from an asset allocation point of view. So yeah, so I think and it's interesting. There's actually a huge glut of supply that's coming in from the secondary market as well. A lot of people, like the small retail guy, there's cost of living crisis, so a lot of retail investors goes to one assets that's performed very well for them, and the cost of living. They may have children to put into universities. They may have to, buy property, whatever it is. So there's been a lot of selling of gold, and more than people expected. So a lot of supply has come in from there. So, and that's actually impacting the demand, particularly for that 1 ounce gold format, and the most popular gold format for the retail buyers, the 1 ounce. Um, so yeah, but silver, and that's the other thing, and because gold, the relative gold silver ratio is roughly 100 to 1. A lot of bullion people have been buying more silver in a smaller coinable bar format rather than gold. Um, and there has been a move to a smaller gold format as well. There's more quarter ounce buying, more tenth of an ounce gold buying, which is interesting. I think that's a long term trend as well, because it's obviously more affordable for people. Um, and one thing that I don't think it's been appreciated. I strongly believe for a long time that the bullion industry themselves and some of the wider marketplace, I don't think we've appreciated the scale of the demand destruction that Bitcoin and the cryptocurrencies have done to gold and silver, because a lot of money that would have went into gold and silver went into Bitcoin in particular, but also the wider crypto universe, So, and even the Bitcoin ETFs. And that has been a big demand destroyer, So I don't think the retail buyer is there yet, and that again underlines the fact that it suggests that the price gains we've seen in recent months, while very strong, and we're up roughly 20-25% in recent months. And we could correct in the short term. It looks overvalued in the short term because we're well above the 200-day moving average. So from the trading point of view, it looks slightly overvalued. But from a value point of view, it's only when the retail buyer piles in that you would be worried, and when it's front page news on the front page of Financial Times for 1 or 2 days in a row, and it's on Bloomberg and CNBC, and it gets as much coverage as Bitcoin does, that's when you'll be nervous that we might be coming towards the end of a bull market, or it's overvalued and due a sharp correction and a period of consolidation, as we see with all assets. Yeah.
Great point. So we're not quite there yet. I think that is definitely true. And just because you mentioned silver, let's take a look at silver as well, because the price has been on the move in the last couple of weeks. I think today we're in a little bit of a down day for silver, but it is on the move up. What do you see as silver's path forward? Do you see this price rise as sustainable? Of course, we know that silver is also known for its volatility, so it's a little bit hard to gauge what could be coming next.
Yeah, exactly. But it's nearly impossible to silver now in the short term, given that volatility. And it does look a bit overvalued in the short term, a bit like platinum as well. It's a big move. So short term, who knows? But medium and long term, its outlook is it's as good as gold, if not better, because there's obviously massive supply demand deficits for years now. Um, And yeah, people are looking at it as very undervalued, not just relative to gold, but also relative to stocks and bonds. The industrial demand is very, very, very strong. And we have those deficits, global deficits. And the industrial demand may be a little bit vulnerable. Obviously, if we got a sharp recession, then that could be impacted. But I do think that the investment demand and sort of safe haven bullion demand would compensate for that, you know. I do think there is some smart money now, including, you know, high net worths, ultra high net worths, who are looking at silver as not just a very interesting speculation to make a return, but also a form of safe haven asset akin to gold, you know, because it has the same properties, obviously. So there is, I think there's a guy called Bateman. There's a multi-millionaire he's bought a huge amount of silver in recent months, and he did a post on X.com. I think he's a tech entrepreneur. I don't know much about him, but it was a very interesting post he put up on X.com, basically saying he believes silver was the greatest opportunity of our lifetime. There's something akin to that. I can't remember the wording he used, but he just said that that's where he was putting his money because he believed it was a massive, massive opportunity. So there's, you know, I would say there's a few hundred individuals like that, and the silver market is very, very small. The physical silver market, in terms of above ground refined supply of particularly 1,000 ounce silver bars, because that's primarily what drives the price. And all it takes is a small amount of global capital flows to move into silver, and it could propel the price much, much higher. And I do believe that will happen. I believe that would happen 5, 10 years ago, and it didn't happen. So I'm cautious to get into, you know, but you know, the $100, $150 to me is again conservative over the next 3, 4, 5 years. I do think genuinely we're going to go there, you know. Obviously, we're at $50 in 1980. We're at 30, whatever, $37. So there's nothing. I don't think there's anything in the world that is below the price it was in 1980. You know, and admittedly, that was a short term. You know, it was the end of that 9 year bull market, and it was a speculative blow off top. And but at the same time, if you look at even the average price of silver in 1979, I think it was roughly $21, $22 was the average price for the year. So, you know, we're at $38, so we're less than 100% below the average price from 1979, which was what, 45, 46 years ago, you know. Silver is very, very undervalued. I think share value of silver is probably, you know, between 100 and 150, and then you could get a spike up to 150, 200, 250, which again, even as I say that, I'm very, very bullish on both gold and silver. And as I hear those words come out of my mouth, I say, "Oh, that sounds like a crazy prediction," like, you know. But I do think it is. I think it's likely. Yeah, I'll be given the scale of risk in the world. Yeah, and silver has really interesting applications in the industry as well as being a monetary asset. It's just it's used in people don't realize how many things it's in. Like probably on the devices that we're both on, Charlotte, there's probably little filaments of silver in some of them, you know. And unlike gold, because the gold is much higher price, when gold prices go up, we see the phenomenon of gold getting recycled and it comes back into the marketplace. And, you know, that we even have the cash for gold phenomenon where the jewelry gets sold at certain prices, and it gets melted down and comes back in the system. But the silver is, yeah, it's tiny little filaments of it, you know, so it doesn't tend to, we haven't seen that even when gold or silver went to $50 in 2012. There wasn't any sort of silver cash for silver phenomenon, you know. I think we'd only see that if silver went up to $150, $200 per ounce. So, and the other thing about silver that's very important to know is that the price inelasticity, whereby most commodities, most things, when the price goes up, the supply goes up, there's an increase in supply. But with silver, because it's a, excuse me, because it's a byproduct from primarily a byproduct. There aren't many primary silver mines, so it's primarily a byproduct of base metal mining. And it depends on the nature of the recession we get and how severe it is, but that could impact the demand for base metals. And therefore, you may not see a big increase in mining supply from silver, you know. So it has characteristics that, you know, very much suggest it could go much, much higher. And again, it's important to realize silver is going higher, but it's also the dollar's being devalued relative to gold and silver.
So very bullish on gold as well as silver, but like you mentioned before, we're still missing that retail crowd. And I wondered if you could talk a little bit. I know that every person is different and people need to take into account their own circumstances, but when people are looking at gold and silver, maybe when we're finally getting to newer people who are coming into the sector, how much gold and silver in general should people be owning, and what types of products should they be looking at when they're building that physical portfolio?
Well, yeah, as you said, it depends on risk appetite. It depends on their age, and more so, I think it depends on. It's always good to look on outcomes and goals and what they want to achieve with their lives, and how they want to use. To me, it's not an investment; it is a form of saving. So when I talk about it, I'm not giving financial advice to anybody. It's more I can tell them how I view it and how many of my clients would view it, and increasingly they do see it as a monetary asset, as a store of value, basically. So, so I think everybody, to me, it's like the bonds in the portfolio, in a bond, in a diversified portfolio or a so-called balanced portfolio, you would have, maybe 40%, 50% bonds, 40% equities in a cash position. But given the scale of risk to bonds in the world today, I think I think it's been interesting. Like back in my old company, the rule of thumb was always 5 to 10%, and that was sort of accepted in the financial industry and by financial advisors, 5 to 10%. But today, even the financial advisors are saying, and a lot of research suggesting that as an investment portfolio, you could easily have 10, 15, 20% in gold. But I think, as I said, as I alluded to, I see gold as money, and therefore, and I see it as safe. It's a tier one asset, highly liquid as well. It's a store of value, and therefore, I look at it vis-a-vis bonds. And therefore, if you could have 40 or 50% of your net worth, your investments and your savings in bonds, why couldn't you have 30, 40, 50% in gold? Now, I'm not telling people to do that, and it is a very high allocation. But given the scale of the risk in the world today, many, many people are doing that. And again, it depends, as you alluded, it depends on how they view the world, how they see that risk. And it depends on also their existing assets, whether they have stocks, bonds. It's very interesting. Over the years, a lot of the people who would be buying gold, they didn't tend to be people who are have like stocks and bonds and balanced portfolios. They tended to be entrepreneurs. They tended to be people who bought property tended to buy gold. It tended to be they liked the tangibility, and they trusted that more than the paper bonds or the paper stocks or digital stocks and bonds. If they already have big allocations to property and tangible assets, then maybe you don't put 40 or 50% in gold, obviously. But I think for a young person, we always used to say, well, younger people, they can take more risk, obviously, and then older people should take less risk. I think that's true to a degree. But at the same time, this Bitcoin thing, I think a lot of young people are going to get very, very burnt. I hate to say it, I'm a libertarian. So from day one, I was very positive on Bitcoin, and saw its potential. But over the years, I'm nervous about it, and I think it is a speculative asset, and it could do really, really well. But it should be a small amount of your portfolio. But today we have people going maximalist, and putting 80, 90, 100% of their wealth into cryptocurrencies, and it really is crazy stuff. And in time we'll look back at it and we'll say that was a mania, and that was crazy, and the financial media should have analyzed it better, because there's a lot of cheerleading and there's stuff going on that if the gold industry did some of the stuff that the Bitcoin industry is doing, people would be horrified, and the gold industry, we tend to be very conservative and we don't tend to go crazy. So anyway, 46% is very, very high. I'm not obviously telling people deal, but I think you could easily have 40, 50% in gold, silver, 30% gold, 20% silver, 5%, 10%, or 5% platinum. Platinum is very interesting as well. And then, rebalance when they outperform, as I believe they do, you can rebalance it. And that comes back into the goal or the outcome, basically in investing or saving because you want to buy a property, you want to buy a family home, you want to have a nest egg for your children. So, and that's a great way to save in gold and silver And then in 3, 4, 5 years, there will be, I believe, much more value in other assets, you know. Maybe it'll take longer. It could be 6, 7, 10 years, you know, but I think, yeah. So being slightly, that's a long way of me saying be slightly more overweight gold and silver than traditionally we would have been. Yeah.
I know that's a tricky question, so thank you for going into
Yeah.
that. It makes a lot of sense the way you explained it. I think
Thank you.
that's a great place to wrap it up, unless you had any final thoughts that you would want to leave people with right now.
Um, no, just, yeah, there's a lot of fear, and fear is very disabling and leads to irrational thinking. And, you know, people just need to take a step back. And, you know, as Roosevelt said, he wasn't very kind to gold, and he started off this process of devaluing the dollar, but he did have that great quotation, which is there's nothing to fear except fear itself. So, you know, there is risk, there's risk in risk assets, there's safety in gold. And that's the great thing about gold. It confers sort of peace of mind for people, you know. And but the key thing is that you have to own it in the safest way. So I would be, you know, unless you're speculating, if you're speculating on gold and taking a short-term punch, then obviously you can use futures and options and ETFs. But they are financial products that have quite a bit of risk in them. And I've read the prospectus of these products, including the ETFs, and, you know, you are a non-secured creditor in a product basis. So I would encourage people to own the actual physical asset, coins, bars for larger amounts, but also have coins as well. The visibility of coins is good, and so, yeah, and check out the Tara coins there. I'm a bit biased, but I do believe they're some of the most beautiful medals or rounds in the marketplace, and they have that intrinsic value. They're 49 pure gold, and I think we're doing relatively small volumes right now. We only start in 2023, so I think in time they'll actually have almost like a collector premium, and a lot of people buying them as, you know, as stores of value that will have both. You'll have the intrinsic value of gold and silver in the coming years, but potentially will also be a sort of a collector's premium potentially, you know. So yeah. So yeah, diversify is the key to everything. Don't go overweight Bitcoin or cryptos or stocks or bonds. You know, yeah, diversify, and yeah, it's such a cliche that eggs in different baskets, and have a few big gold eggs and silver eggs, and you'll be fine.
I think that's a perfect way to end. So thank you so much for coming on today to talk about gold and silver and the markets. This was really great for me.
Thank you, Charlotte. Yeah, thanks a million for having me on.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Marco Byrne with Terra Coins.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.